This is the financial report analysis of the Australian public listed company NextDC in 2021. This is a summary of the financial year information. So we find that from the income statement, the sales are for $246 million in 2021, increasing from 2020. The EBITDA, which are the operational costs, they were for 42 million. The depreciation and amortization by 94 million, and interest and tax and borrowings by 63 million. So they got a net profit of minus 20 million. It means that they were not profitable during 2021, and they are still paying for previous borrowings. In the previous year, in 2020, they paid even for a bit more of borrowings. In the balance sheets, they have total assets for 2.6 billion, liabilities for 980 million. So this is the total equity. And in their cash flow, the operational cash flow, investing, and financial cash flow, there are the amounts here. The net cash flow in 2021 was a negative 240 million, while in 2020 it was a positive value. It is due to 844 number here that we find. This was because they received funding and they started paying for that in the next year. The horizontal analysis, the revenue has been growing since 2018 to nearly double to 2021. This data indicates a clear positive trend in revenue since 2018. On the other hand, the net profit was positive in 2018, and since then it has remained as a negative value, having its lowest point in 2020 and improving during 2021, but still remaining as negative value. It is likely that NextDC acquired a relevant borrowing of more money, which is helping increase their revenue, probably directed to pay for those debts, leaving the net profit in negative values. In the vertical analysis, we can see in the chart too that NextDC in 2021 presents an asset allocation of 71% in property, plant and equipment, followed by cash and cash equivalents with a 24%. Property, plant, and equipment are the main asset allocations for NextDC. In the chart number 3, borrowings for the period 2021 presents 29% of the total assets, while the net assets account for 62%. It means that 1/3 of the company is financed with debt. Depreciation and amortization is the largest expense in the income statement, accounting for 38% of the 2021 revenue, followed by finance costs with 25%, direct costs with 17%, and employee benefit expense with 15%, leaving only 4% remaining in other expenses. It means the company uses 63% of expenses in amortization and paying for their debts. In order to talk about their business performance and financial ratios are useful because they help obtain quick first conclusions about how healthy a company is in their operation, and they tend to be different depending on the type of industry. For NextDC, relevant financial ratios, in the table 2, it presents financial ratios relevant to the analysis of NextDC from an investing perspective. Return on assets and equity have a positive increment, while return on sales has slightly decreased. Efficiency ratios show a positive increase in the net asset turnover, while the debt ratio remained unchanged, while the current ratio increased nearly 4 times in 2021 compared to 2020. The return on sales ratio, this is how much percentage of the revenue is actually converted in the earning of the company. This was 19% in 2020, and it decreased to 17% by the end of 2021. The sales were higher in 2021, However, the operational side is performing at a slightly lower level of efficiency while the company is still growing. The return on assets. This is how effective is the assets management to generate revenue. For 2021, it was 1.6, maintaining a similar value compared to the previous year. The company requires a high level of investment for its operation and returns low operational profit. For each dollar that the company has in assets, it is only returning 1.6 cents in operational profit. The return on equity indicates how efficiently is the company handling the money that shareholders contribute. It is usually good between 15 and 25%. NextDC has 1.8% negative return on equity in the 2021 and 2020 years or financial years, as the net profit was a negative value after paying financial obligations and taxes. The company is growing at a fast pace, which requires constant investment. NextDC has very high costs related to the depreciation of plant and equipment, plus financial responsibilities from previous borrowings. The return on equity is low compared to other companies in the industry. However, none of the other local companies have a similar revenue or asset value. The company hasn't reached its point of maximum return, so investors are probably expecting to have a high level of return in the long term. The net asset turnover. It indicates how much sales the firm generates for every dollar invested on total assets. It increased from 7% to 9% in 2021, indicating that the revenue is increasing at a faster pace than the assets. This is due to a slightly decreased in assets, while the revenue continues growing. NextDC has a positive net asset turnover rate because they have been growing their operation at an exponential rate since 2010, typically securing deals with clients before starting the construction in each one of their new data centers. It means they already have their future capacity already sold for above 75% of the capacity once the new data center is ready, and therefore ensuring their future revenue. The debt ratio indicates that 37% of the assets were financed with debt during 2021 and 2020. As it remained unchanged, a healthy ratio for companies is usually around 1/3 of their assets. NextDC has historically raised $2.4 billion in funding since 2010, growing from 1 data center to 9 at the end of 2021. It has total assets for $2.6 billion and a market capitalization of $4.9 billion. NextDC has plans to continue expanding and covering its expenses with debt and revenue. The company has currently secured $1.85 billion in funding, from which $0.8 billion were already spent, and the rest will be spent during the next 5 years. The current ratio grew from 2.5 in 2020 to 9.3 in 2021, which indicates that the company has too much cash compared to the current liabilities. The company has a high working capital amount, which is probably going to be destined to support their operation, construction of new data centers, and payment of debt. As an important factor to analyze is that NextDC financial performance, as well as the industry, is the depreciation and amortization of property, plant, and equipment relevant to their operation. A limitation of the current report is knowing to what extent the plant, machinery, and land really depreciates. According to the financial year 2021, depreciation and amortization of plant and machinery accounts for 38% of the revenue. In other words, for each dollar in revenue that the company receives, 38 cents are destined to overcome depreciation and amortization, on top of the other 36 cents to cover operational costs, leaving only 26 cents to cover financial costs and final revenue, which in the end is negative value. The price to earning ratio from the past 12 months prior to this report is 663, while the price of to earnings ratio of the industry is 171. It indicates any investment in NextDC might take up to nearly 4 times the market average time to return. It is important to appreciate that the company's efficiency ratios are lower than the market's average. However, NextDC is the local dominant competitor in the cloud computing sector with a market capitalization of 4.59 billion, accounting for over 87% of the local revenue when compared to its competitors and according to the Findbox Online website.